Hello, I'm Edward Sterling, macro analyst for Bulwark Bullion. Gold has been on an extraordinary run recently. As of April 8th, gold is trading around $4,804.50 per ounce, pushing toward new historic highs and extending one of the most powerful rallies the metal has seen in decades. And what's fascinating is when this surge is happening, because it's unfolding during one of the most volatile geopolitical events in recent memory, the escalating conflict between Israel and Iran. But here's the twist. Today, the United States and Iran announced a 2-week ceasefire, an attempt to pause hostilities and open a window for negotiations. Normally, when tensions ease even slightly, safe haven assets like gold pull back. But that hasn't happened. Gold is still climbing. So the obvious question is, why is gold still rising even after a ceasefire? To understand that, we need to look deeper at what's actually driving the gold market right now. When the conflict between Israel and Iran intensified, markets immediately began pricing in the risk of a broader regional war. Energy markets reacted first. Oil prices surged as traders feared disruptions to Middle Eastern supply routes, particularly the Strait of Hormuz, one of the most critical oil shipping corridors in the world. Roughly 1/5 of the world's oil supply passes through that narrow waterway. Any disruption there could send global energy prices soaring. But when the 2-week ceasefire was announced, oil prices fell sharply as traders began pricing in the possibility that shipping routes would remain open. Equity markets rallied on the news. The US dollar weakened, and yet gold continued pushing higher, reaching roughly $4,804.50 per ounce. That tells us something important. Markets are not treating this ceasefire as a resolution. They're treating it as a temporary pause in a much larger geopolitical risk. The single most important force pushing gold higher right now is uncertainty. Even with a ceasefire in place, the underlying tensions between Israel and Iran remain unresolved. Military forces remain mobilized. Regional alliances are shifting, energy infrastructure has already been damaged, and negotiations are only just beginning. Markets understand that a 2-week ceasefire is not the same thing as lasting stability. When geopolitical risk rises, investors begin moving capital toward assets that are perceived as stable stores of value. Gold has historically played that role. It carries no counterparty risk. It isn't tied to the profitability of companies, and it isn't dependent on the fiscal stability of any single country. That makes gold particularly attractive when geopolitical risks rise. But gold rarely moves because of just one factor. More often, rallies occur when multiple macro forces begin moving in the same direction, and right now, we're seeing several reinforcing drivers. Currency movements. Following the ceasefire announcement, the US dollar weakened as markets adjusted expectations around inflation and interest rates. Because gold is priced globally in dollars, a weaker dollar often makes gold cheaper for international buyers. That tends to push demand higher. Energy market volatility. Even though oil prices dropped after the ceasefire announcement, the underlying risk to global energy supply hasn't disappeared. If negotiations fail or conflict resumes, the Strait of Hormuz could quickly become a major pressure point again. Markets are aware of that risk, and that uncertainty continues to support safe haven demand. Central bank gold buying. Another factor many investors overlook is central bank demand for gold. Over the past several years, central banks around the world have been purchasing gold at one of the fastest paces in decades. Countries increasingly want reserve assets that are not dependent on the U.S. financial system. During periods of geopolitical tension, that trend often accelerates. Gold becomes not just an investment, but a strategic monetary asset. To understand what's happening now, it helps to look at the macro chain reaction. Conflict in the Middle East leads to risk, to global energy supply, leads to oil price volatility, leads to inflation, uncertainty, leads to currency movements, leads to investor demand for safe haven assets. That sequence of events is exactly what markets are processing right now. But there's another layer to this story, because geopolitical shocks rarely occur in isolation. They often collide with broader macro pressures already present in the global economy. Before we go further, if you're enjoying this breakdown of the precious metals market, make sure to hit the like button and subscribe to the channel. The global economy was already navigating a complicated environment before this conflict escalated. Inflation remains elevated in many regions. Central banks are still trying to balance controlling inflation while avoiding economic slowdowns. And global debt levels remain historically high. When geopolitical shocks occur in an environment like that, they tend to amplify instability. Investors begin asking deeper questions. Could energy disruptions reignite inflation? Will central banks need to respond? Could supply chains face further stress? When those questions begin circulating through markets, gold often becomes a natural hedge, not because it generates income, but because it represents a form of money that exists outside the traditional financial system. Over the years, I've watched the gold market long enough to know that major rallies rarely come from a single cause. They happen when geopolitics, monetary policy, and investor psychology begin moving in the same direction. And right now, those forces appear to be aligning. Looking ahead, there are several key indicators that could determine where gold moves next. First, the outcome of ceasefire negotiations. If the 2-week pause leads to a broader diplomatic agreement, geopolitical risk could decline. But if negotiations fail, tensions could escalate again. Second, oil prices. Energy markets remain one of the most sensitive indicators of geopolitical stress. Third, the U.S. dollar. A sustained weakening of the dollar could provide additional support for precious metals. And finally, real interest rates. If inflation remains persistent while interest rates stabilize or decline, real yields could fall, which historically supports gold. Gold's rally during the Israel-Iran conflict isn't simply about fear. It's about uncertainty. Markets are trying to price the possibility that geopolitical instability could remain a defining feature of the global economy. Even with a temporary ceasefire in place, investors appear to be preparing for a world where tensions remain elevated. And in that kind of environment, gold often becomes one of the most attractive stores of value. If geopolitical tensions remain unpredictable, even after temporary ceasefires, could gold continue attracting global capital as investors search for stability? Thanks for watching. If you're interested in gold, silver, and the macro forces driving global markets, make sure to like the video and subscribe. For more analysis, visit bulwarkbullion.com. I'm Edward Sterling, macro analyst for Bulwark Bullion. See you in the next one.